Hello and welcome to etbfsi.com. My name is Amol Dete and I'm in conversation with Samir Narang, the Chief Economist of Bank of Baroda. Mr. Narang, welcome to the show. And what I would like to learn from you is, everybody is talking about the optimism which the budget has created. I would like to take your perspective specifically on the economy. How do you review this budget as an economist and what kind of changes do you see in the economy after this budget?
So I think Amol, it's a very good question. I think the expectations from the minister were sky high. She's actually been able to exceed even those sky high expectations from this budget. If you see the quantum of increase in terms of spending, leave alone next year, this year, which she has uh, spoken in her budget speech in the revised estimates, is a sharp jump from what we had estimated when she had presented the budget last year. So, leave alone next year, even this year, she has kept a very large sum for spending for food subsidy, for MNREGA, and even for Capex. And next year also, she has allocated an even larger sum for capital spending. So, all in all, uh, the budget meets the need of a pandemic struck economy. It also creates enough room for demand to be created next year and this year for economy to kickstart itself. At the same time, it touches on the nuances required for higher private sector participation in the economy through privatization and asset monetization. So all in all, I think it ticks all the right boxes for growth revival.
So I think when you say that it has ticked all the boxes for the growth revival, sounds really good and optimistic. So obviously we have chosen the path for the growth, and we are ready to go ahead with whatever fiscal stimulus is required. And obviously it went up because we are investing heavily now into infrastructure and all. What I would like to learn from you is what could be the drawbacks of increasing fiscal deficit at this point of time. Yes, we do understand that that is a need of the time, that is a need of the hour. But what could be the drawback ultimately?
Again, a very, very insightful question. So when you are discussing, the entire boost that the finance minister has given to spending, the other thing is that the resources have been constrained. The direct tax collections, corporate tax collections are going to be far lower than what was estimated earlier. Even the GST collections will be lower. Only excise duties this year will be higher, and that too on the back of sharp increase in the excise duty that the FM had announced in the May of last year. So the government had to resort to much higher deficit financing through borrowing. Both short-term borrowing is likely to be much higher than last year. Long-end borrowing, the government had already increased to 12 lakh crores. Now it is the FM announced in the speech that it will be another 80,000 crore higher this year, which she will tap the markets in the next 2 months. In addition to that, the government will tap into the funds of the small savings, which is the National Small Savings Fund, uh, largely post office fund. So these are the three main sources of funding the fiscal deficit. When the government is going to allocate so much of savings or household savings for itself, it naturally means that the bond yields are likely to go up. Already we saw that today, while equity market went up by approximately four percentage points. At least the bank nifty has scaled to its sharpest up move it has seen ever. At the same time, bond yields also went up materially today. So that is the offset, to the in terms of the higher deficit financing.
I think you explained it really well, but and you also mentioned about the banks. I have that question, but let me come back to you a little later. Let me ask you about specifically the infrastructure. I mean, the government said two, three very important things that they're not only investing heavily, but ensure that the capex is reaching on time and the project is also completing on time. And they gave an example of Bharatmala project has already completed 3,000 kilometers. And what is unusual is they are spending huge amount in at least this three four projects from Tamil Nadu to Kerala, to even West Bengal. You know what kind of impact this investments will create in the economy to generate demand, to generate consumption, and also encourage India Inc. or corporate India to invest.
See, Amol, that's again a very good question. The fiscal multiplier of 1 rupee of investment, particularly in construction, is perhaps one of the highest. The reason is that once you do that, you are actually consuming a lot of cement, a lot of steel. It is also labor intensive at the same time because you require a lot of road laying work for which labor is required. And if you have to buy land, the land also belongs to India. So every rupee of investment that is done for construction, in particular for road, the large amount is actually spent in the core sector for or for labor or for buying the land. So most of the money actually stays within or circulates within the economy. And so it has a very high fiscal multiplier. And I believe this is the best way to kickstart the economy. Even during the NDA one under Atal Bihari Vajpayee, the maximum emphasis for revival was on building a very large scale road network. If you see, and even today, that road network is of help to us because it cuts the time it takes for trucks to deploy on the road. It improves your medium-term growth prospects. It improves your supply side conditions because goods can travel faster, people can travel faster. More people are connected to each other through those roads. So I believe that is the best way to kickstart the economy in the long run. And I think the money is being very well spent.
Okay, quite interesting on that front, Mr. Narang. My question is also about raising debt, raising funds, and the government has spoken specifically about the disinvestment. The target for last year was really high, but obviously we entered into an unusual time like COVID-19, and maybe government could not find a right way, because the focus had completely shifted, and now they're coming with a different plan. The target is obviously smaller than what they had last year, but my question to you, sir, here is: by any chance, if government doesn't manage to raise 1,74,000 crore, which they have estimated over the next, few months or the quarters, what are the other options available for government to raise the money, to raise the funds, because they have, announced heavy plans for the investments.
No, no, actually, that's a very good question again, right? So we've been missing these targets for some time, and but it's the nature of the target this year. For instance, as you said, the target is less than last year, and equity markets are at an all-time high.
Right.
Right, that is one. Globally, equity markets are at an all-time high. We've seen a very robust inflow into Indian equity markets over the last 2 months. I think apart from the previous 3 4 days when there was some FPI selling, we have seen record $8 billion kind of inflow in the month of November and December into the equity markets in India. So there is a pool of capital available from abroad. The strategic sales have had some issues, as you pointed out. We've not seen to the extent that we would have seen earlier, perhaps because of the COVID situation as well. However, the next year's target has an inbuilt IPO from LIC, which in itself, can generate anywhere around 90,000 to more than 1 lakh crore if the government chooses to disinvest even 10% of its stake in LIC, because that is the overall equity valuation of that entity. In addition to that, the amounts that have been spoken about from the disinvestment of BPCL, Air India, Bharat Earth Movers Limited, and a number of other companies. My sense is that this kind of number is actually quite reasonable. We may exceed expectations. However, as you're correctly pointing out, that if there are some challenges and issues, then perhaps the government will have to resort to borrowing from the National Small Savings Fund or short-term borrowings. My sense is the preferred option would be the National Small Savings Fund, because after the borrowing that we're going to see from government this year, the next year budgeted borrowing from that on that account is much lower.
Okay, I think that is again a very good explanation, Mr. Narang. And specifically on the disinvestment side, I don't want to ask you how important that move is, because that, we are actually going back to privatization from nationalization, and but the market is also waiting for it and praising for it. But I have a slightly different question. According to your judgment, according to your analysis, which are those two banks?
Very difficult to say. I think your guess would be better than mine. Very difficult to say. But however, just to give, I think it's difficult to name the banks. But if you look at the government's approach, and if you, I'm sure you would have also read the Naik committee recommendations.
Okay.
I think the banks which have seen consolidation, they will remain strategic in nature. The banks where consolidation has not happened, which are also slightly smaller in nature, perhaps could be the ones. But you know, uh, your guess perhaps would be better than mine.
And one more, last important question is specifically about, they have actually focused specifically on the foreign investment. So looking at even Gift City, IFSC, and more importantly, the FDI in insurance has been increased to 74%, which is actually quite interesting because last time when the FDI limits were increased from 26 to 49%, huge amount came and a lot of companies, actually took a benefit out of it. So overall, considering this view specifically on the foreign investments, how do you look at it?
I think for India's economy to grow in the see, India is a capital strained economy. What I mean by that is that we typically run a current account deficit. The reason for our current account deficit is that the domestic consumption and investment is much higher than the resources that we generate domestically. So what you see is the saving investment imbalance, which is the domestic saving investment imbalance is funded through the foreign investment. So we typically get enough resources in the form of capital inflows to fund our current account deficit.
True.
Now, there are two parts to it. One is the requirement of technology, and the second part is the requirement of capital.
Hmm.
We as a country have tremendous amount of resources, not even apart from oil, the other natural resources, and also we have very good quality of labor, as we have seen in case of IT sector and even in select manufacturing sector. So, to give you an example, we are perhaps one of the largest producer of two-wheelers in the world. We are exporting our products in the African markets. Perhaps not in all markets because the products are geared towards the Indian market and they qualify well for the African market as well. European, Latin, and the other markets have a different product need. But that doesn't mean that we cannot manufacture them, right? Because if you can do it for one product segment, I'm sure you can do it for other product segments as well. So what we require is the right amount of capital, the right technology, and the right infrastructure. If you have these all the ingredients put together, then there's nothing stopping you from growing at 8% as well and gaining market share in certain key export segments such as be it electronics or telecom equipment. So I think this budget put in conjunction with the corporate tax reduction and the PLI scheme for the 13 sectors which was launched earlier, the infrastructure focus now brings it all together. So in that sense, you require capital, you require technology, and a large part of it can be funded from abroad, where investors are looking for steady returns, and this is a growth market which is actually offering you very good returns. So my sense is that if we get our act right, the way the budget is shaping things up for the economy, I do see that India's medium-term growth prospects have definitely improved if you put all these three things in conjunction together.
Absolutely, and that comes to my last question, which is again, once upon a time, it sounded like a very, very ambitious plan, and somehow we are heading towards it with some strategy. The pandemic obviously disrupted that, but again, I would like to ask the same question: are we on track in terms of $5 trillion economy, or we will, be late on the target which the government had set?
If you have a pandemic kind of situation, it may not be fair to, uh, because the target was also set before the pandemic came, right? So, in essence, wherever we will see the nominal GDP of the country come after the this year's growth, perhaps you would have missed a year in terms of the overall growth trajectory. Uh, so perhaps it may not be fair, to hold somebody accountable for a target or a number which was given pre the pandemic. However, I would say that it is still very credible, uh, you know, in terms of the reforms or in terms of the plans that have been unveiled by the government over the last 12 to 18 months, starting from the corporate tax collection. So I think the strategy in terms of reviving corporate investment in the country continues, and it will show very good dividends in the next 12 to 18 months. So we need to be patient. We need to keep our eyes on the ball. And my sense is the policy framework is creating the right conditions for growth to revive in the medium term. So we just need to be patient
Right.
and keep our eye on the ball.
I think that was again a very good anecdote. And let me take one more minute from you and ask a last question specifically about the job creation. When we look at the investments that the government has done, yes, there will be a lot of jobs in different segments will be created, but there is nothing directly as such that the government has done specifically to boost the employment or to create the job. Am I right in that in understanding that, or is there something else also which perhaps I didn't understand?
No, so I think the way to look at it is that perhaps you're right. The reduction in corporate tax will not create any jobs directly. But what it does is that it leads to an improvement in the return on equity or return on investment for every rupee of corporate investment. So it creates an incentive for corporates to invest. That is one. The second is the PLI scheme. The PLI scheme actually directly leads to job creation because it leads to direct targets on investment, on sales, on exports. The moment you have to do investments, jobs will get added directly. The third part is the investment in Capex or building infrastructure or roads, or for that matter, MNREGA spending that the government is doing. These are directly job creators because the more the government spends on these activities, they will definitely lead to a job creation. So my answer is that yes, some of the incentives or government policies may not directly lead to job creation, but they create conditions. Some of the others do directly lead to job creation.
All right, Mr. Narang, those were amazing views, and thank you so much for sharing your inputs at our platform, News Portality, BFSI, and etcfo.com. Thank you so much for your views.
Thank you, Amul. As always, it's a pleasure talking.